And I'm going
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. We're ready to get started. Thanks to all of you for registering for this Ontario Systems webinar produced by insideARM.com, diving to student loans, demystifying the ARM industry's biggest market. I'm pleased to share the mic today with Ontario Systems VP of Sales and Marketing, Jason Harrington. And we are joined today by Brad Dey, CEO at Coast Professional, where he's been tenured for more than 22 years helping to collect student loans under a variety of functions, including operations, IT sales, sales, and marketing. Brian maintains an International Fellowship of Certified Collection Executives designation from ACA International and has achieved year-round perfect CPCS scores from the Department of Education. And Brad Dey is an established operational consultant with more than 12 years of experience in collections. Originally a marketing director with Capital One, Dey helped develop the company's first TV ad campaign before moving into recoveries, where he held a number of positions accountable. Where he held a number of positions accountable for hiring, growing and retiring third-party agencies, and debt buyers. Today, Brad is the COO of Second Order Solutions, providing credit risk mitigation, collections, and recovery expertise across many asset classes, student loans, and credit cards chief among them. And finally, hi, I am Mike Bevel, an editor here at insideARM who has trouble reading from a script. A few pieces of housekeeping. Please note the questions box available to you. All your mics have been muted, however, you can send your questions via this chat box at any time during the presentation. Some will answer during the presentation, some will save for the Q&A at the end, some we won't have time to get to, but we're going to do our best. This question comes up a lot. You will receive follow-up materials like, for instance, this PowerPoint presentation from Ontario Systems within a week or so of this webinar. Please make sure you take a few minutes to complete the survey after this webinar ends. The information is incredibly valuable to all of us who are producing these webinars, and we value your thoughts and opinions very much. Also in this survey, there'll be space for you to ask any additional questions that we did not cover in the webinar or get to in the Q&A. Ask it there. Someone, I think, knock wood, will get back to you. My final bit of housekeeping, the legalese that I have to say out loud. You'll also see it on the screen in front of you. This information shared in this webinar is not intended to be legal advice, but simply informed opinions from a panel. It may not be used as legal advice. Legal advice must be tailored to the specific circumstances of each case. Every effort has been made to ensure this information is up to date. It is not intended to be a full and exhaustive explanation of the law in any area, however, nor should it be used to replace advice of your own legal counsel. The presenters, Coast Professional Inc., Second Order Solutions, and Ontario Systems assume no liability for typographical or other errors contained in the presentation of materials or for changes in the law affecting anything discussed therein. All right. Some fun facts to set the stage for us. Student loan market now represents the second largest debt pool in the U.S. Unpaid student loans make up the highest growth collections market in the country, topping $1 trillion with a T in 2013. Federal student loans, your Staffords, Perkins, Plus categories, make up the majority of the student loan market, totaling about $850 billion. So over the course of the next hour, Jason Harrington, Brad Dey, and Brad Dey, whose phononyms you can see right there on the screen, are going to walk us all through the ins and outs of this marketing segment. We'll cover market sizing, market drivers, basics and fundamentals, thoughts on how to approach this market, and then at the end we'll do that Q&A I mentioned. But to get us started, I'm going to hand your attention over to our good friend Jason. Jason?
Thanks, Mike. I appreciate that. Before we get started here, I just wanted to say thank you to everybody who's taken time out of the day to come spend it with us this afternoon. This webinar sort of was born out of a couple of years that I've been on the road, and in my job I get to see a lot of your shops, and whether you're an existing customer or maybe a prospective customer, and there's always two groups of folks out there, and one group is already doing student loans, and everybody else is always asking about, what about that market? What about student loans? It's been a lot in the press, and it's a very popular market to talk about. And so we thought maybe it'd be a good idea to get some guys who really understood the market to kind of explain it to us. So that's why I'm really pleased to have Brian and Brad, who are not just customers, but also friends of mine, to be able to explain something that they're very, very versed in, much more so than myself. So you're not going to hear a lot from me today, but Brad and Brian are going to take us to the basics. Hopefully the goal of this webinar is for you to understand the market, what drives it, and where maybe some opportunities that you could grow your own business inside this market. So with that, I'll turn it over to Brad, and Brad will get us started.
Okay, hopefully everybody can hear me okay. I always like to frame things up in terms of looking at the sizing of the market, and then we're going to, as Jason was referencing, we'll be able to talk through how your best way to perhaps, enter this market. There has been a lot of press about this topic. It is one of topics that has hit Main Street press, USA Today, Wall Street Journal, about the fact that this is now a $1 trillion pot. And I think that number, the $1 trillion, scares a lot of people, and I think it gets a lot of people attention. There was $100 billion funded in 2010. However, the debt burden, which is something that we're going to talk about in a second, which is a big driver for this industry, continues to rise. In the tin box on the right, you can see that on average, the recipients have an average of $25,000 more, than the average debt back than they had in 2001. So it's just interesting to see that the pie is getting bigger, and the amount of people that continue to come into it and incur more debt continues to rise. There has been no slowing of enrollment due to the rising cost of college. Just want to move to the next slide. What this is just a little more detail around that. And the cost of college, as I mentioned, has continued to rise. And what's been interesting is that tuition revenue has been the biggest driver in order to allow that. So I think it's been understood that the state level funding to some of the universities has been dialed back, and unfortunately that gap has been passed on to the enrolling students. And so as you can look through here, looking through, the recession timeframes are denoted. You can see that the tuition revenue as a percentage of the total educational revenue really continues to rise at really accelerated levels. As you look at these levels that are coming through over the last couple of years. So it's one of those that we have not seen a leveling occur, and everything continues to go up as we continue to monitor this market.
Brad, I want to offer something here.
Absolutely.
Something that you see in this, the obvious is it goes up. Something else that you want to see is sort of the cycle within this this phase here, this period of time. If you look just before a recession, look at the 91 recession. Just before, what happens? Student debt spikes up. And then what happens? It sort of rounds out, it plateaus. And then look at just before the recession in the early 2000s. What happens? It spikes up again, and then it rounds out or plateaus. Here again, the recession was longer than the prior two. Actually, they get successively longer. And again, you see the spike up, which you would expect to see a plateau. There's a lot of market drivers. Why does debt go up during the recession? Well, people are reskilling. They're retooling. They're going to go back to school when jobs are scarce. So you're going to see that process. And so moving forward from 10 to 12 and beyond, you would expect to see the same sort of process where a premium is put on retooling, re-educating, finding a new skill set, and then you're going to see that rounding or plateau. So I just wanted to point that out.
No, that's a great point. Yeah, I think as the job opportunities for that graduating class are limited, and obviously as those loans have the potential of entering into repayment, you do see, let's just say, accelerated levels of people opting to re-enroll and perhaps go for a graduate degree. So thanks for that addition, Ryan. Next slide, please. I'm not going to go through. This is just this show gives you some of the additional detail. There are also part of this presentation is intended to make you aware of. There are some great data sources that we can make available. Obviously, insideARM is a nice source of a number of these as well. But I'm not going to read through the chart here, but it gives you some of the detail around you can look at the acceleration per borrower and per graduate, what that looks like over the last couple of years. Next slide, please. This one's interesting for us because a lot of today's meetings intend to help people understand the different buckets that are rolled up into that one big bucket called student loans. So this shows you looking at really 3 different cohorts: the 03, 04, the 07, 08, and then the 11, 12 academic year. Utilization of federal versus private student loans. What's interesting is that if you look over on the far right, obviously everything continues to increase as you go through, but one of those tends to drop. On the far right, you can see that the utilization for private student loans from 11 versus 07 is the only one that is decreased. It doesn't match the trend lines for the all versus federal. A lot of this is due to the securitization market drying up for the origination of private student loans. A lot of the participants that were in there in the 07 are not there, or at least they're in reduced levels in 11. Those are some of the big drivers that lead to that. Brian, I don't know if you wanted to add anything else on top of that.
Well, sure. The private credit market was susceptible to the economic downturn. It's not part of, obviously, the direct. We're going to get into some of these definitions. If you're familiar with some of these terms, you understand. If you're not, we're going to get into some deeper definitions. This is the overview. We'll come back to a few of these things. But essentially, the private market is more traditional. It's more bank-oriented, where the direct market is more either federally subsidized or direct out of the federal out of the Department of Education. So you're going to see that turn, and that's because, as Brad pointed out, the market has changed, and the financial picture between those 2 points had changed. So there are a couple of things happening here. And direct lending went from approximately 21% of the total financial aid disbursements and went to 100% of those federally no longer federally subsidized, but direct lending. So there's a couple of features at work, but primarily these are more traditional products that most of the attendees, I think, would be familiar with.
Okay. Next, this is a chart. What jumps out at me, the source of this is the New York Fed that generates a quarterly report that I encourage you to pull down. But this looks at delinquency rate by loan type. And what's interesting is that there was a lot of discussion around Q1 of 2012 with the credit card decline and the increase of student loans. And what you see is the loans have the lines have not only crossed but have continued to diverge there. So mortgage delinquency, you can see what that trend line looks like, and I'm sure some of this is why many of you are participating in this call and wanting to see this as an asset class that you would like to pursue further. But we break it, in a subsequent slide, we look at, based by age group, what this looks like. But, the delinquency type by loan type, for many of the reasons I mentioned before, of, entering into repayment, decelerated levels of job opportunities, for this new class. But student loan, continues to go up at an increased level, and as I mentioned, it's separating from the credit card line. It's a pretty self-explanatory chart, but really jumps off the page.
Yeah, I'd like to offer another key indicator, another key item on this chart is that these other lines are traditionally susceptible to bankruptcy. And so in the economic downturn, in that 08, 09, 10, it really washed out a lot of those portfolios or relieved the consumers of the obligation to pay some of those outstanding balances, where student loans, a large portion of the student loan portfolios are non-dischargeable. So nonprofit educational loans provided for student benefit. So they're immune, well, in many cases, not in all cases, but in many cases immune to that process.
And the only other thing that I'll also add, Brian, is that forbearance was a non-cash tool that was pretty widespread in student loans, particularly in private student loans. And really in the 2010, 2011 is when a lot of visibility, regulatory visibility, was placed on that tool. Perhaps given the high recidivism rate of the amount of people that were using forbearance to get temporary relief and avoid a charge-off, and then perhaps, well, actually not even perhaps, we're coming right back into default status again. So there was a lot of visibility placed on that tool, being really a false payment mechanism, and I think that also led to some of the increase, a step change uptick in terms of the delinquency rates specific to student loans.
I agree.
Next slide, please. This just looks at it by age part. It is interesting that there is, because the long repayment times, this is an asset class where you do get to look at some of the later stage age groups in terms of repayment, given the cosigner rates that are so applicable. I believe a lot of I just saw a stat the other day, I think 90% of all loans are have a cosigner currently. That led to some of the increase of originations in private student loans. It's been a substantial part of change in the underwriting, but you can look at it by the group, and as you can imagine, the younger than 30 is the group that's probably most impacted for new college graduates entering the job market. But it jumps off the page on what this looks like for people falling behind on their student loan payments. Some things have been done to make people aware of their obligation, and we'll talk a little bit later around a program that's called Early Awareness, which is a lot of education on people of when their full loan burden will come into them and the expectations of them of entering into the billing cycle. Whereas in college, they typically have a decreased obligation or no obligation at all to be paying against those student loans.
So this next chart is a simple explanation. We joke it's a simple explanation, but this next chart gives you an idea of how the funding process works. Now, if you want to go buy a car, you go to the dealership, you select your car, and you say, I need a loan, and they go to whatever lender, and they get a loan for the car. Financial aid doesn't work that way, and although it's become more simplified since the summer of 2010, there are still options available. So in other words, I have a financial aid need of $25,000. Well, you may get 5 of that from one source. You may get $2,500 from a grant. You may get $10,000 from a private lender, etc. And so you have a financial aid portfolio. And what this chart does, it gives you an idea of how simple or how complicated that process is. So you can start, you've obviously got the Department of Education here, you've got the federal side, and then you can follow the lines of funding. You've got the players, you've got the university, you've got private lenders, and you've got parents, the student, and servicers, and obviously the different ways in which the sources of funds. So let's go through. So the federal side, I think everyone understands, federal government is the big player in student loan origination. You've got the private lenders, which would include the private credit markets, the traditional banks who going back to the original chart that Brad was presenting on, have not gone away. They've obviously pulled back some, but have not gone. Sallie Mae, Texas Guarantee, New York Higher Education, etc., that still have billions of dollars in loan portfolios. Federal Perkins loan, just going down here on the left side, Federal Perkins loan, those are federally subsidized loans. that are originated and dispersed at individual college and university campuses. So those colleges and universities that opted to participate in that program manage that fund. They manage the disbursements, and they manage the collections and recovery of those funds, and they continue to revolve with those financial aid offices. Deferment and forbearance are different vehicles. Brad touched on those. Different ways in which you can pay, either not pay at all or just pay a simple interest assessment and not a principal contribution. So if you have a hardship, typically it's a financial aid hardship or financial hardship. But let's just say you go back to school. You can have a school deferment, whereas you say, I'm not ready to enter a repayment plan for this loan because I'm in school. There are several different things that you can defer your loan for, depending on the loan type and depending on the program, and in some cases, depending on whether or not you've used that deferment or forbearance time. In most cases, that time is limited or for certain programs. Cohort default rate, that's a way in which to track the performance of our portfolio out of borrowers. There's a next slide that will go in further, but actually it's the next slide, but we need to stay focused here. To determine how the portfolio is trending in defaults, takes a numerator and denominator approach, and we'll go into that in the next slide. For-profits are what you think they are. Banks, there are several examples in here. You've got capital markets and private lenders. Those for-profit financial aid resources all contribute to this cycle of this financial aid portfolio process, where it's very untypical to receive one loan for your financial aid needs when you are going to school. So running through this system here, you'll see the top lines, some of the green lines that say loans under FFEL pre-July 1st, 2010. So the change in the financial aid origination system, prior to that date, the FELP or FFELP originators were doing approximately 4 out of 5 loans originated. After that point, the Department of Education had taken over the origination of those loans. So the last stat, the most recent stat that I've read is 21% of all financial aid was being originated by the Department of Education. 79% was originated through the FELP program. After that point, 100% had gone through direct lending, so it's a single source. Now, the difference is you had several originators, some of the names that I referenced before, and Sally Mae and others, generating those loans. And they would service them, and then you would have a collections process, and they still have billions of dollars and very large portfolio management systems, and they still need a lot of servicers to help them with those portfolios. But now the department is taking on that piece. The let's see, the Parent Plus loans, we'll talk a little bit about that later, but it's effectively a cosigner. And you've got some federal subsidies for some of those loans, and there's also the cosigner process in the private credit market, as you might expect. If you need a loan, you can get a cosigner. So some of the other things that are outlined here are home equity line of credits, credit cards, et cetera, as other financial aid sources. There's not one way to do this. So relative to the participants on this webinar, there's a lot of entry points into the market. Some larger, some smaller, some more, some less sophisticated. And there actually may be something in your portfolio today that would give you an opportunity to enter the market.
Thanks for that explanation. Brian, one thing I would like just to layer on is that what's unique to student loans is the concentration that occurs with, the loan servicers. Given all these vehicles, even, the FELP versus direct lending, there really are 4 central loan servicers in the pre-default space, which I find unique and that everything flows through them, especially prior to, again, the default activity. So there are, you can research and find out the names of those 4 servicers. Actually, I'll just say ACS, AES, which goes by FIA, Nelnet, and Great Lakes are the 4, really the 4 horsemen of loan servicing specific to student loans. And as you can imagine, given the relationships of both the FELP and the direct, they have a large concentration of student loans under their control.
That's a good point. That's a good point, Brad. And at this point, Mike and Jason, we talked about the possibility of opening at least this area to maybe some questions submitted. Mike, I'm not sure how you want to do time management on this.
I want to do it well, and so as I said, if you have questions specifically about this, so I have some questions that have come in before this, and I'm glad you asked those, and we're going to save those for later. If any of you listening have specific questions about this slide, and also just a reminder, you're going to get a copy of this slide. So if you are trying to trace your screen, I would stop that because it is not going to help you, but you will get this. Somebody's asked, can you repeat the 4 horsemen?
Yeah, absolutely. It's ACS, and I don't believe how it's, let's see, I'm not sure how the acronym spells out, but they are owned by the Xerox Corporation. Then the next one is AES, which is American Education Services, and they also go by FEAA, PHEAA, which is the Pennsylvania Higher Education Assistance, and they're located in Harrisburg, Pennsylvania. Then you have Great Lakes, and you have Nelnet. And again, those are, they do manage loans in both pre-default. I know they do post-default. They do have some limited outsource relationships as well. But it is unique in that a lot of the loan programs and even how they're originated are all, I don't want to say constrained, but they all flow through the limits of those 4 servicers, how they work systemically. A lot of those actual loan notes flows through those 4. So that's very unique, especially as you compare to Bankcard, that concentration amongst those 4.
Someone is saying that their understanding is that ACS is out of the picture now, that their existing ed loans were distributed to a number of NFP arms of GA servicers.
I know that.
Yeah, go ahead, Brad.
No, go ahead, Brian.
I was going to say there was a change of contract recently at the end of the year, so the participant is right. There's been some restructuring in that area. However, the concentration for those servicers is still that is still correct in that there is a high concentration of work between those servicers. That's really at from looking at this. My idea is if I'm sitting there and I've not had a student loan portfolio and I'm very interested in getting into the system, that there may be some opportunities there, but they're certainly not the linear path that I would take into the student loan market. There is work to be done for sure in those areas, but as far as the traditional third-party market and not the servicing side or the resolution side, and we can talk a little bit about the difference. Resolution, you want to collect the account. There's many other ways to resolve and assist your partners, your portfolio partner, with taking care of these defaulted accounts. So we can get into that a little bit further, but yeah, there has been some movement at the end of the year. To your participant's question,
several people have asked about Sallie Mae.
Mm-hmm.
Just are there 5 horsemen technically, or how does Sallie Mae fit into the 4 horsemen metaphor?
Brad, I'll let you take it.
Sallie Mae wears quite a few hats. In terms of their servicing of the from the FELP portfolio. And the direct lending, the new origination. So they absolutely do. I'll give them a horseman for sure. In that they control a large percentage of the private credit and the government side, and are a key driver of this industry.
All right.
In addition to being, I'm sorry if I can also add, in addition to being one of the largest originators themselves on the private side. So they're a servicer for the new direct lending. They certainly are a servicer for a lot of the aggregating guarantors from the old FELP days, and they also now are a servicer and originator for their own loans in the Sally private world, in addition to having a private loan consolidation product, which so they pretty much sit in every can.
All right. If you guys want to go ahead and move us on to, should I move on to the next slide?
Sure.
I'm sad to see this one go, but here we go.
Okay. CDR, cohort default rate, liquidation rates, and this is what we talked about before. In the prior slide, we said we would further explain. Cohort default rates are used to determine the portfolio's performance, and specifically, how is the portfolio trending for a fixed period of time with a fixed criteria of either borrowers who go into default for this period of time or within graduation or separation, or coming into repayment, etc. So it's a numerator-denominator process, and you may think, as a participant on this call, you may think, well, why wouldn't you just look at the entire portfolio and look at liquidity for that portfolio, and then you get or default and get a sense of what's happening. It's really about a trend, and it's really about tracking specific information in that cohort default rate, which is something that within the student loan world, this is the method by which you track portfolio default and performance. Do you want to add something to that, Brad?
No, I just think it's unique in that it is a snapshot metric. There are always borrowers that are coming into repayment and coming into it, and there's obviously people that are coming out of it as well. So, but it is unique. You will see CDR and cohort much in the way that you hear liquidation rates thrown around in the Bankcard world.
Okay. All right. So. Next slide, basics and fundamentals. So you've got the federal system, which we've described, which is now doing disbursements, five-fold disbursements over where it was just a few short years ago. You've got the private side. The private side is still very much alive and well as far as portfolio size, maybe not on origination. So if you're looking at simple trends, originations have stopped in one aspect, have been significantly curtailed in another aspect, say in the private credit side, as we saw in the chart at the beginning, and direct lending has exploded. So that said, it's still the portfolio sizes for the private side. Those portfolios are still enormous. There are huge opportunities. If you're looking at student loans, you say, well, looks like the federal side or the public side is the only way to go. Absolutely not. There are huge opportunities in the private side and private credit, still in the FELP program, and several other areas outside of, say, the department's program to break into the industry. The federal contract, we could spend probably days, or at least a full day, describing an overview of the federal program. But essentially, the department is doing that direct lending. It's a growing area. There are some opportunities to possibly do some subcontracting. It's in the midst of a renewal currently. The private requires substantially less capital for a collection agency. Now, it will cost. There are programs that you're going to have to invest in for different loan types and resolutions for, say, rehabilitation. That's a long process. And you're not going to see the full amount of the resolution that you'll see. You're going to get paid maybe as you go, but you're going to get paid on seeing a borrower through to resolve the account and to get it out of default. Now, the rehabilitation process can be different. It is different for different loan portfolios. But effectively, it's multiple payments, multiple long-term payments, typically, say, 9 payments over a 10-month period of consistent qualifying payments. And there are different calculators to determine the qualifying payments over that period of time. If the borrower completes that, they complete qualifying payments over that period of time, then the loan can be, if it qualifies, as rehabilitated, and it's closed out of the agency's inventory, and the agency will receive a fee for rehabilitating or seeing the borrower through the rehabilitation process. So now you get small amounts for those payments as they go, and you'll see typically a larger amount at the end of the rehabilitation process. What that means is you're probably not covering the costs of your staff in mass on volume for that rehabilitation start. You're only going to get paid if you get to the end of the process, or you're not going to get what will, quote unquote, cover your costs for that rehabilitation until the end of the process, typically. So that means you're going to have to make those investments in that pipeline of revenue generation for your company and have to budget and realize that that process is going to take place great distance from today. So maybe you get a new portfolio, and that's how that portfolio, those resolutions are key to this particular portfolio or the rehabilitation process. You have to expect you're going to start that rehabilitation, even if you start at that first month, see it all the way through, 9 payments over a 10-month period of qualifying payments, and then maybe your client, whomever that is, public or private, would pay you either in the same month, well, typically the following month, or the following month after that, depending on their process. So you could be very easily 10 or 11, maybe even 12 months after the start of the rehabilitation of that loan. So I think that's a key item. Whether it is federal or whether it's private, there are very large portfolios. I would say the largest portfolios today, currently, the significant amount of revenue is generated by that process. So it requires the agency to be prepared to not get paid significantly or substantially for that type of work for almost a year. The role of servicers in the effort in origination and collection, it creates confusion. Well, this says it creates confusion. There are processes, there are due diligence processes and mechanisms that those servicers, whether they be the originator or the third-party servicer, to follow. That's ways in which to communicate to the consumer the status, obviously the loan balance, et cetera, but the status of their account. As we described before, and as the chart illustrates, there are several different ways to meet the needs, the financial aid portfolio needs, to pay, say, for tuition. And that's going to come from a lot of different sources. And that can cause a challenge or create a challenge to keep up with. And so the current system, post-2010, you would say, well, it's far easier because you've got direct lending increasing, but the opponents would argue there's less choice. So there's always a trade there.
Hey, Brian, so I could add something
go ahead.
here real quick.
Go ahead.
This is one of the main points that, one of the reasons why I wanted to share this storyline with the participants, because I think what you just said there in sort of the middle part of this slide, I think is really, really important for folks on the other side to understand, and that is student loans. Obviously, we've established the fact that it's big and it has all these great attributes about the marketplace. But it needs to be a long-term strategic decision by an agency to enter into the market, because it's not a quick hitter. It's not I'm going to get 1 or 2 customers and it's going to cash flow itself. It requires investment. So I think your comments there, sort of word to the wise, is it's a great place to end up, but you got to be pretty purposeful about ending up there. Otherwise, you have a chance to spend a lot of money and make a lot of investment and not get much return if you don't understand that dynamic is really it's a longer journey.
I think that's important that we stop and we clarify that and talk about that. It is a long walk financially in many cases on these portfolios, especially the larger portfolios, with particularly direct and FFELP loans, that the goal is obviously to get the account out of default. If the borrowers have the means to pay the account, obviously they'll pay the account, but many times, many times, the borrower is not able to, as you might imagine, pay the entire balance. So then you have this qualifying rehabilitation program, which is terrific. It allows borrowers to get out of default, get a second chance, and go back into repayment. What ends up happening is once they complete the rehabilitation process, their credit is cleared. The account goes back to a servicer under new terms, new qualifying payment terms, and barring any other defaults, any other outstanding defaults, they could actually be eligible for financial aid again. So you can take a borrower over a short period of time, relatively short period of time, less than a year, who's in default, who's accelerated, technically balanced and full is due, take that borrower, walk them through the rehabilitation process, and a lot of wonderful things will happen at the end of that process. Now, what it means for an operator, what it means for a servicer or an agency, is that you're getting paid a very small amount on those initial payments. But what you're betting on is seeing the borrower, the consumer, get to a successful rehabilitation. And at that point, you'll earn the fee that you would expect. But if you don't, if you're not prepared financially to have a pipeline of those accounts at various stages, buckets, if you will, in the first pay bucket, the second pay bucket, all the way through to the rehabilitation process, then you have borrowers that fall out and have to go, it sort of shoots and ladders. You have borrowers that slide back down to the bottom, and they've got to start up with bucket one again. If you're not financially prepared for that, it can be financially devastating. There are examples, none that I would like to share, of companies that have really, really struggled, saying, I can do it cheaper, I can do it faster, I can do it better than the last girl or guy that was on this portfolio. I know how to run an efficient company, who just simply weren't prepared, and it hurt them. I don't know anybody who's, well, I don't want to get into those examples again, but it's something that you have to realize, that your client is not going to pay you. You just have to put it in your mind. Your client's not going to pay you for up to a year for what you're doing. Now, they are paying you, and those are all part of the terms, but what you're going to see profit on, or what you're going to see, what you would expect in other markets, like you have the debt, you pay the debt, you get the money. That doesn't happen typically. That doesn't happen on the larger portfolios or the larger loan types within the industry. So it's a key point.
I think we made the point. I want to make sure I want to make sure that the audience really grasps that, because I think it's such a different nuance to this particular market. Brad, were you going to say something?
Yeah, I was just going to layer on as well the importance of systemically, what we just glossed over, or not glossed over, of, keeping track of where those payers are in the course of the chutes and ladders, as Brian said, of 9 payments. I mean, a strong collection system that allows you to say, well, this payment counts, this one doesn't. You're typically allowed one, get out of jail free card of one missed payment, as Brian mentioned, 9 out of 10 payments. You can move, those dates around a little bit to say that this is one that came within this 30 days, so this one counts as the 6th payment. So you can imagine systemically, and to be able to consistently report back to your client on, okay, these are the ones that are eligible, these are the ones that are paying, these are the ones that are satisfied with terms of the rehab, this is the one that's eligible for a capitalization and a payout. You really need tight systems and reporting to be able to execute on that, and making sure that you get compensated in the right manner at the end.
Well, yeah, and to your point, Brad, then there are nuances within the rehabilitation system. We talk about qualifying payment. But qualifying payment under what program? Is this a full AM or a neg AM? Those are phrases of art within our industry. A full AM, it says we're going to pay off the account over, say, a 10-year period. Fully amortized loan. It's what you would think of when you buy a car, using that example, or buy a home. By the end of the 30 years, if I get a 30-year fixed, I should have paid off the home by then. To use that example, that's a fully amortized loan. You may have a negative or neg-am loan program, which says I'm making payments based on my earnings. I'm making payments based on my income. Well, those payments may qualify for loan programs because it's based on the borrower's current financial situation, current financial hardships. So they're qualifying payments, but they will not pay off the loan within, say, 10 years. You may be covering interest. You may be covering less than interest because it's not a traditional bank product. So you're not looking at it from that perspective the goal is to get the borrower out of default and give them a reasonable and affordable payment. So that is the goal when resolving those accounts for those borrowers whose income levels qualify for that type of program. But you can't just stripe a portfolio with who's a reasonable and affordable rehabilitation, who's not, et cetera, et cetera, et cetera. You have to look at the individual borrower. You have to collect information from that individual borrower, and then your teams, your operations teams, have to apply the appropriate program to that individual borrower, then begin the process of bucket 1 through bucket 9 over that period. And as Brad pointed out, the skip-a-month process can typically come into play, not always, but typically. And you'll ultimately see the borrower rehabilitate, and that is a way, that's a primary way, at least for us, to be successful on this contract, or this contract and every several other contracts that we have. Jason, you want to go a little bit further into that, or are you comfortable?
I think we've made the point, which is,
okay.
For those that are on the phone, or for those that are in the webinar, and this is the strategy they're thinking about, just make sure that, the word to the wise is, just plan wisely. And it's a different kind of planning than, say, if I want to expand my business into telco or another asset class that's, sort of different. So I think we ought to keep moving forward with the slide deck, but I think that's a really important point, so thanks for elaborating on that.
Okay, last bullet here is non-cash cures as a resolution tool. You have forbearance. There's also permanently and totally disabled, incarceration, deceased borrowers. There's several resolutions that we process for our various clients in our portfolios. They're not what you would think of as collecting accounts. You'll receive a fee. It's not typically the highest fee that you're going to receive, but it's a way in which to filter and resolve certain circumstances that borrowers will encounter. And so you'll typically receive some compensation for that. But it is an important part of most portfolios. The simple way to think of it as sort of a filter. It's not the bulk of the work that you'll be performing, but it is some of it, and it is compensated. Do you want to add anything to that, Brad?
Nope, I think it's good.
Okay. Okay. Next slide, please. How are student loan collections different from Bankcard? So bigger balances, we can talk about student loans and dischargeability, Bankcard averages versus student loan averages. We've looked at the charts together. We know that student loans is a growing portfolio. We know, or I'm sure that we've all read that rising cost of tuition is a big concern. It's a very real thing, and the portfolio grows, and those debt sizes typically grow with each year. Now, for us internally, looking at our numbers, our public side, average balance is about $11,000. Our private side, subsidized, are about $14,000, and our campus-based subsidized loans are about $3,200. So those are the three areas. We can get into some other campus-based tuition or institutional programs, but those are the three largest programs that we deal with, and those would be the average balances for each of those. So, bigger balances, example, extensive work effort above what segmentation tells you. There are a lot of different ways to work these accounts. There's a lot of different needs and responsibilities. Non-dischargeable in bankruptcy, we talked about that. Talked about how that influences the overall portfolio size when credit cards used to be the king, and for various reasons, economic downturn, credit issuers were tightening their belts as far as qualifying and lending. They're susceptible to bankruptcy. There's a number of factors. In addition to that, when we looked at the recession chart and we looked at how those recessions influence patterns of behaviors with students and consumers about reskilling, all of that comes into play when you're looking at a recession and you're looking at how it's different than a bank card. A co-borrow can often exist, which requires a skill talk-off. The majority of financial aid disbursements will not have a co-borrower, but they're obviously an important part of different loan types, particularly on the private credit side and the plus side. The parent co-sign loan on the subsidized side, and there are very specific requirements for those loans and how it's not a situation where all the terms and conditions are going to apply specifically to the parent, maybe on the subsidized side. The private credit side is more like a typical product of what our attendees are probably used to, but there are very specific guidelines on how the communication is affected with the co-signer on the subsidized side. Younger demographic, obviously they're students. Many people go back to school later years, but on average, obviously those loans or that demographic is going to be younger, fewer assets, greater potential for long-term improvement. You're going to see this has been more influenced, obviously, going back to the chart, the recession chart. You're going to see an older average age in the portfolio since, say, 2008, on average, on that rolling average, than prior to 2008, going back to the other recession, because you're going into these sort of these peaks and plateaus and peaks and plateaus sort of systems. So right now we're seeing an uptick in age of borrower, probably because of that chart that we talked about earlier, where they're going back to school. Adversely, a student can seriously hurt their credit score and negatively impact them on a life situation develops, ability to apply for a mortgage. This is a key topic. This is obviously very important. The CFPB is looking at that, and various other. The department is very interested in this idea and how it affects the economy overall. There are a number of terrific programs. Rehabilitation is clearly a key driver in that area. That's not something that, using the car example, if you got behind on your note, you can't call your auto lender and say, I just like to not pay. It's a financial aid. It's a financial hardship for me to pay my car note. So get back with me in a year, and maybe I'll start paying it again. That doesn't happen. If you default on the car note, the lender isn't going to say, well, how much do you make, and we'll fit payments around your earnings or your income, regardless of how long it takes you to pay off your loan. So there's a number of things that are different about student loans, but still, given the size of the portfolio, given the size of the market, and given how much debt there is and the average amount of debt that students graduate with, it's still a concern. And there's a lot of effort being made to find other creative ways to assist borrowers so it does not negatively affect them for those long periods of time. Less aggressive pre-collections efforts done. I would argue that there's just less aggressive, period. We take a customer service approach. For example, on our largest student loan portfolio last year, we had over 1,000 pieces of complimentary correspondence, which is extraordinary. Very proud of our group for getting 1,000 pieces of complimentary correspondence. Those are the borrowers that took the time to actually submit it. Probably, whatever times number that were very satisfied and that would have, that just never got around to it. So that's something that's a KPI within the organization that we look at just as well as we look at performance metrics, other traditional performance metrics. The complementary correspondence angle and that the consumer resolution and satisfaction metric is very, very important to us, not only overall in the portfolio, but on an individual collector, debt collector basis. Documentation is usually better. I would say that's true. Obviously, we specialize in student loans, so that is our standard, and that's our expectation. But obviously, I've heard there's issues sometimes in the medical world, sometimes in the debt buyer world, and even with credit card issuers that the documentation can be difficult to obtain. For whatever reason, the debt buyer market remains fractured and less developed. I would say that given the federal subsidy to some of these accounts, particularly on the FFELP program and the PLUS loans and the Perkins and NDSL, the old NDSL program, and clearly the direct lending program that comes directly from the department, the need for that is obviously much less. Now, there are other for-profit schools. There are portfolios out there, but they're very rare. And I think for those reasons that so much of the financial aid origination is done either with a subsidy or directly by the department, that the need for that type of market is just not there. Brad, did you want to add something to that?
No, I just think I consistently have people reaching out from that side, and a lot of people have been able to enter into asset classes via the debt buyer market. It was a popular way to get into issuers 6 years ago, and now I think that it isn't as developed as a mechanism to get into student loans is go find a debt buyer, one of the big three debt buyers, and try and get into their network. That does not work really as an entry point into student loans.
Okay, I agree. Let's go to the next slide on private student loans. Brad, if you wouldn't mind, if you want to take the private student loan side, and I'll take the federal loan side.
Yeah. And really quickly for both of you, if you could, let's try to get through these next few slides a little quickly. I have a whole lot of questions I think people would like you to get to.
Okay. The main point that I wanted to get across here is some of the names of the participants. As I mentioned earlier, Sally Mae is a quite large participant. Behind them, Discover, Wells. There has been, Citibank used to be in there into that list. So just to give you some rough sizing of origination volume, I know this is 2011. I have seen some comparable ratios for 2013 originations. I think we've touched upon the average balance. So, Brian, you just want to cover the federal side?
Yeah, sure. Much larger market. We talked about the origination side for the department. Not only was the department doing, now it's doing fivefold, but even prior to that was doing a fifth. Still, a lot of the FFELP programs would turn over those defaulted accounts to the department, to the government claim process for work through the Department of Education. So although the loan origination was being done by those FFELP participants, the department still was a very important player in the resolution of those accounts, and the relationship between those originators and the department was very, very strong, particularly on the default side. So those accounts would ultimately roll to the department given certain conditions, and it would move from the FFELP portfolio into the department's default portfolio. So yes, market is much larger. Very specialized process and requirements. We can go on and on about the specific processes, but the thing that you need to know is the department is very sensitive to borrowers, the process, the opportunities, the detail that goes into the ability for the borrower to resolve their accounts in a reasonable way, and communicating those expectations with their partners, and their partners communicating those opportunities with the consumer borrowers is a very, very high priority, and probably not even the high priority, it's the top priority. So the specialization and the procedures that go along with that are very detailed. Lengthy qualification process for prospective contractors. This, by the way, is a very detailed process. Any of the participants can research that through a Google search for any of the groups that Brad has talked about or that I have talked about, and their qualification process, their procurement process, and the opportunities to service portfolios with those organizations. And we can talk about maybe some other entry points toward the end of the presentation. Different tools required: rehabs, IRS garnishments, or what's within the portfolios that we're familiar with is administrative wage garnishment. It's a process. It's another collection tool that's available on some portfolios. Slower to show profits with your payer base. We talked about the bucket system and the rehabilitation process and how that works, and the financial preparations that an agency will need to undertake, the planning, very strong budget planning that they'll need to undertake if that is the type of portfolio that they have an opportunity on. Some opportunity to work on behalf of for-profit schools, and we'll talk about those opportunities, the entry point opportunities for some of those toward the end of the presentation. So next slide. I'm going to speed it up here, Mike. Brad, you want to take pre-default?
Yeah, touching upon pre-default here, as I mentioned, the interaction with the servicer and that passing of information regarding media. There are various student tools. We've touched upon the forbearance and the MGRF and the various payment options, co-borrower specific strategies in terms of making them aware of the loan obligation. But typically in the pre-default space, I will say it involves a lot more education because there's multiple disbursements typically tied to a semester. The servicer might have changed, or the lender might have changed amongst your first year in school versus your fourth year in school. There is some competition with federal loans. I mean, it's the same borrower, so sometimes you have to overcome that debtor confusion of, are you calling regarding this loan versus that loan? And a lot of time it's servicing the SLAs and actually meeting your SLAs by doing daily dialer effort and making sure you're touching all of the accounts in the manner that you committed to contractually.
So post-default, the key items in post-default is how you manage multiple accounts. Systematically, those are the drivers. We've got a great partner in Ontario and what they do and how they support our efforts and allow us to be competitive on those contracts. Without that, it's just simply not possible or practical to not only not have a systematic process, but to have an efficient and dynamic systematic process to achieve those contract needs. Workflows and SLAs, those are key again to ensure that you've got the right account on the right program following the right process. Payments applied across loans. This is an interesting topic. So we talked about different loan types. Within our portfolios, you'll have multiple distributions of multiple loan types, and we talked about rehabilitation and how important rehabilitation is. Well, certain loans qualify for different rehabilitation models. Certain loans don't qualify for certain rehabilitation models. So, and different loan types are typically paid differently. So all of those factors come into play. When you're running and budgeting, you've got to find out how you run and budget a contract, but also how those loans qualify for those various programs are key. That's a key item. If you get a borrower, typically the borrowers are going to have 4 to 5 loans on average. And it's not uncommon to see a dozen loans tied together. You've got it tied at the borrower level, consumer borrower level, but you'll have multiple loans under that one consumer borrower. The trick is, as a servicer, as a collection agency, is to know which loans qualify for rehabilitation, if that's how you're going to resolve the account, and what the qualifying payment is, taking into consideration their entire defaulted loan package that you're servicing, and to get to the right payment. So that's key, and again, that's where we lean on technology. Cosigner is king. Skip tracing importance. Again, we have cosigners in that portfolio. There's cosigners in the public and the private, in those private portfolios, and knowing what you can and can't do is critical. Wide range in liquidation rates amongst issuers due to pre-default work strategy differences, and the relationships we talked about. We talked about the FELP relationship with the department and its portfolios, and what could have started with a FELP originator and gone through their process, and their servicers, their agencies, may end up in the department's portfolio and go through their servicers and their agencies for resolution. So what is the liquidation rate when it was with the FELP originator, and what the liquidation rate is when it's ultimately in the department's portfolio, is obviously can be very different. Different bankruptcy approach, we talked about that. We talked about dischargeability, and rehab is sometimes available. So let's see.
Hey, Brian, can I suggest that the next couple slides are really more sort of FYI, and the audience is going to get to the decks. And we ought to just slide into Q&A, because I think there's a lot of Q&A that Mike has that I think we could address.
Okay.
So, Mike, I'll turn it over to you.
All right then. Hello, me. So I have the first group of questions are all around bankruptcy and student loans. So I thought I'm going to ask the first, and then I will see by your answer if you touch upon the others that show up.
Okay.
But the first one is, do you have an estimate for what percentage of student loan debt ends up facing a discharge request in bankruptcy?
Well, Brad is going to probably have the same challenge in answering that I'm going to have, is the unlicensed practice of law. But I will tell you in a very broad and general sense, I don't have the specific number of borrowers who go through the undue hardship process in the bankruptcy process. The discharge that you'll read, when you read a discharge, it says various other things, but the key phrase within that is hereby discharged of all dischargeable debts. And in many cases, different loan types are non-dischargeable. So the hereby discharged of all dischargeable debts acknowledges those exceptions. And in some cases, in a number of cases, financial aid or student loans are determined as non-dischargeable. I can quote a section, but if you Google student loan dischargeability, all the participants here, and Google student loan non-dischargeability, you're going to come up with a section of the USC. Don't quote me. I think it's 523A, subsection A8A. May have changed. Don't take that to the bank. I encourage you to research as a starting point 523A, 8A, I believe it is.
All right. So to that point about dischargeability, so most, somebody wrote on Inside, I understand for the most part that ed loans are not dischargeable in bankruptcy. However, can they fall out of SOL, and then are they collectible or not?
Anything can be determined as dischargeable, right?
Right.
Anytime you get into a court proceeding, anything can happen. The judge has the ability to determine enforceability. But there is an undue hardship process in bankruptcy that again, you can research and get the details on. But if it is determined that the loan would present an undue hardship, and undue hardship is granted specific to specific debts that would be otherwise non-dischargeable, then they can be relieved. There is a process to relieve. It's very rare in my experience. I had one of my lawyers joke that it's the unicorn of the bankruptcy world. It just doesn't happen. It's very, very rare. It does happen, but it's rare.
Do either of you want to talk about what opportunities might be available to attorneys who want to participate in the student loan collection process?
Brad, go ahead.
There are opportunities there. I think that in that instance, there are attorney networks that have specific needs. I have personally engaged with different attorneys in that capacity, as well as whether the networks such as Track America that is out there. I know that some of the issuers, whether it's the First Marbleheads of the world, do engage attorneys. So there is opportunities there. It tends to be very localized, just within. I would hate to say a little more fragmented in that just a single state. And a lot of that has to do in that the originations are very regional. And so I would encourage you to perhaps follow, in that case, many of the traditional avenues of reaching out to some of those issuers and approaching it that manner. A little bit easier for an attorney than from a traditional agency. Because
I would add, yeah, go ahead.
Go ahead,
Sorry.
Brian.
Well, what I was going to say is I would add that unlike many other segments within the market, the student loan collections and resolution, there's a lot of opportunities to do things other than just collect the money. And when you have, in many cases, the loans are statute of limitation exempt. In many cases, the loans are non-dischargeable in bankruptcy. In many cases, there are a number of programs that the borrower will qualify to resolve their accounts. In many cases, the borrowers will be subject to the tax offset program, which will apply any income tax refunds. They will be directed toward the loan holder. Otherwise, aside from going to the back to the consumer borrower as a tax return, they'll get a letter saying, "Thank you for filing your return. The $1,100 that you were expecting has been forwarded to the following loan servicer." So there are a number of things that make student loans unique, which, by the way, you're not going to be compensated for that tax offset program. But it makes them unique, and I think in that way, in the overall culture of student loans is a very consumer borrower-centric process. It's a very, very high priority throughout that process. So are there opportunities to resolve accounts through the legal system and the legal collection system? Absolutely. Is it as prevalent as other portfolios? Not by a long shot, because there are so many other tools to resolve, and the pressure is off. You're not fighting the statute of limitations clock. You're not afraid of the bankruptcy. There's a number of reasons why, but overall, in my experience, it's very rare.
All right. Somebody wanted to know, do fees get waived when they come out of default? Well,
on some of the portfolios, if you complete the rehabilitation process, some of the collection fees or cost of collections that are assessed when the account goes into default and goes into the collections process are forgiven or are removed, I should say.
Yep. And then
so that's another carrot.
Yeah, and then another, one of the key carrots on the private side that we're talking about is just the stopping the clock. The interest rate reduction program is a very valuable carrot. If you can get enough qualifying payments to qualify, that is a very valuable tool to get somebody off of the sidelines and maybe increase their willingness to stop the clock.
Certainly.
All right. Let me get on to. So a question came up about a previous slide, one that mentioned less aggressive pre-collections efforts. And the questioner asked, does that mean that you can only make a few phone calls, et cetera, before filing a new suit and serving them with due process?
The first part, you're going to have your client requirements. You have all the same responsibilities under the FDCPA, and obviously federal, state, local collection regulatory requirements. The second part about filing a new suit goes back to, I think, the original question, and my answer would be litigation is rare. Litigation is less than 1% of our effort by far, in our experience with the clients and the portfolios that we assist with.
All right. And then I think, do you guys have 5 more minutes in you? Because I think we can get through 2 more questions.
I'm fine.
Sure. Okay. So one of the questions has to do with selling. Do you guys, and you may not know the answer to this at all, but someone was curious about who the top 5 sellers are and at what stage do things typically sell?
I would, the sales market. What's unique is that I would say there is also a little more of performing and non-performing assets. So I have seen some sales go from, many of the names that I listed earlier for issuers. But a lot of the times, a lot of the appetite is around performing assets or some slice of it, 70% of it performing, 30% of it non-performing, and being able to handle them in that manner. I also have found that there's a lot of non-traditional. So whether it's funds, through the hedge fund variety, or people with hung portfolios, they have been a little more apt to sell, to release themselves of their obligations. So that's what I was speaking to earlier around. It's a little more non-traditional, a little bit harder to find. You can't go to the typical marketplaces that you might for Bankcard and be able to get visibility into these sales. But many of the sales are occurring. I would say they're a little bit more in a test and learn. And some people do sell forward flow arrangements, at default, and use that as a measuring stick to hold up against their network and their internal liquidation rates.
All right, so there's one question I'm going to ask, and then I'm going to talk you guys out. But to the audience, so you guys were asked a lot of questions, and so I hope what might happen is these questions will be looked at by the panelists afterwards, and then some of you may find that your question gets answered offline in an email. I'm not guaranteeing that, but that could be an option. But the question our last question for our time together is, what are the best and worst software platforms for student loan collections out there?
Jason asked this question, didn't he?
He did. He disguised himself as somebody else, but I could tell by the typing.
Absolutely.
Absolutely. Clearly, I've spent my career on Ontario products. I'm obviously very pleased with the partnership that we have with Ontario. Can you do it with other software providers? I am certainly sure that you can. We have a lot of success with our partnership with Ontario.
Yeah, my experience as a consultant in the space, I have seen a wide variety of systems, but typically they require, because of the intricacies of different co-borrowers, different loan disbursements, how those get rolled up, how you integrate into your dialer, making sure that you are TCPA compliant and not just calling the same loan multiple times. It is nice to have a sophisticated system like Ontario has available, so that you could spend time on increasing performance as opposed to trying to manage how many loans you have in rehab.
Well, and I'd like to say I think the key critical part of that answer, that question and answer, is what kind of partnership do you have with your provider? How interested in that segment, that market segment, how committed to that market segment are they? And what are they doing to improve that partnership? How focused and how interested they are in your success in that segment. And I think that, for us, has been a winning combination.
All right.
Thanks for that.
Yeah. So once again, I want to thank all of you for spending the afternoon with us and with all your questions. And we very much appreciate the participation. And I also want to thank, on the record, today's panelists: Jason Harrington of Ontario Systems, Brian Davis of Coast Professional Inc., and Brad Dey of Second Order Solutions. You guys are fantastic, and I think you gave out a lot of fantastic information to our listeners. If you, that means you people who I'm talking to, have any questions about the content in today's presentation, you've got some options. One is you can send an email to editor@insideARM.com, and I will forward those on to today's panelists. You also will be able to, if you please, take that survey at the end of this. When you log out, you'll be presented with the option to do a questionnaire. I left space in there for you to ask your question there. If you didn't get a chance to get it answered here, that might get you an answer, but I'm not guaranteeing it. But I'm not guaranteeing it. I'm not saying anything. And with that, we are off. Enjoy the rest of your, let's hope it's spring, guys, right? Can it be spring? I'd like it to be spring now. Thank you all very much, and we will see you at the next webinar. Goodbye.